The US just dropped bombs on Iran, not sanctions, not threats, real bombs. Multiple cities hit, and Iran fired back. Within hours, silver jumped nearly 5%. Gold started moving. And every investor in precious metals woke up asking the exact same question. Do I buy more? Do I sell? Or do I wait? Here is the hard truth. Most people are about to get this completely wrong. Not because they are dumb, but because they are going to confuse a panic spike with an actual trend. And that one mistake has wiped out more portfolios than almost anything else in market history. By the end of this video, you are going to understand exactly what this conflict means for gold and silver through a clear framework I call the Hormuz decision tree. Because the real driver right now is not the bombs. It is one narrow waterway in the Persian Gulf, and whether it stays open or not is going to determine everything. First, let us lock in what actually happened, because in moments like this, the gap between what really went down and what people think went down, that is exactly where the biggest financial mistakes get made. On February 28, 2026, at around 2:30 in the morning Eastern Time, President Trump confirmed it on Truth Social. U.S. forces had begun what he called major combat operations inside Iran. The Pentagon named the mission Operation Epic Fury. Israel called its role Operation Roaring Lion. Targets hit across Tehran, Isfahan, Karaj, and Kermanshah. Iran did not wait. They fired back. Dozens of ballistic missiles launched at Israel and U.S. military bases across Qatar, Bahrain, Kuwait, and the UAE. One key target was Al Udeid Air Base in Qatar, home to around 10,000 U.S. personnel and one of the most important command centers in the entire region. And then came the one detail that actually moved markets. Iran's Revolutionary Guard Navy issued a warning. Ships would not be guaranteed safe passage through the Strait of Hormuz. That warning, not the bombs, is what really matters for your portfolio. And we are going to get into exactly why right now. But here is what almost all the breaking news coverage is completely skipping over. This did not come out of nowhere. Weeks before the first bomb dropped, both gold and silver had already started moving. Gold had been holding above $2,500, showing strong, safe haven demand. Silver had already bounced 18% off its earlier lows, and on February 17th, Iran ran live-fire military drills directly inside the Strait of Hormuz, and markets quietly started pricing in the risk. So what actually changed when the bombs dropped? The risk became reality. And historically, markets react very differently to anticipation versus confirmation. That difference matters a lot for what you do next. Now let us talk about what history actually shows us, because this is where most regular investors get burned. When a conflict breaks out, gold and silver almost always spike fast. Fear spreads. Money floods into safe havens. That part is completely predictable. But here is the part nobody wants to hear. That first spike is almost never the full story. When the U.S. invaded Iraq in 2003, gold jumped and then moved sideways for months. The conflict turned out far less catastrophic than markets initially feared. When Russia invaded Ukraine in 2022, gold surged from around $1,900 to over $2,100 in just weeks. But by September of that same year, it had dropped below $1,900. Why? Because the global economic damage turned out to be less severe than the opening shock suggested. So what is the real lesson here? Conflict alone does not create a long-term rally in precious metals. Lasting inflation does. That is the line most people miss completely. If a war creates ongoing supply shortages, higher energy costs, and inflation that sticks around, metals can trend for months. But if the conflict stays contained and supply chains keep working, the fear premium fades and metals give back most of the spike. This happens, but sometimes something very different happens. And that brings us to the most important concept in this entire video. I call it the Hormuz effect. And understanding this is the difference between making a smart decision right now and making a very expensive one. The Strait of Hormuz is a narrow waterway between Iran and Oman, only about 21 miles wide at its narrowest point, and roughly 20% of the world's daily oil supply flows through it, around 20 million barrels every single day. Iran controls the northern side. Under international law, some of the key shipping lanes actually fall within Iranian territorial waters. That gives Tehran real leverage. And here is exactly why that matters for your portfolio. Oil prices and inflation are directly connected. If oil jumps and stays high, inflation pressures come back hard. If inflation rises, central banks face ugly choices. And when investors expect higher inflation and real economic uncertainty, demand for gold and silver grows. Goldman Sachs has suggested oil could move above $100 per barrel if there is a meaningful disruption to Hormuz. JP Morgan puts a full blockade scenario at $120 to $130 a barrel. Bloomberg Economics notes oil tends to rise about 4% for every 1% drop in supply. Even a partial disruption moves markets fast. Now, there are backup routes. Saudi Arabia and the UAE have pipelines that can bypass the strait. But those alternatives help. They do not replace Hormuz. Not even close. So that warning from Iran's navy? That is not just military posturing. That is a direct threat to global inflation. And every institutional investor in the world knows it. So now the real question is, which path are we actually on? Because that is what determines whether this is a 2-week trade or a 6-month trend. Based on research from Goldman Sachs, JP Morgan, Lombard Odier, Bloomberg, and Barclays, there are 3 realistic scenarios playing out right now. I call this the 3-path framework. Path 1 is rapid de-escalation. This is the base case. The strikes hit their targets. Iran responds but keeps it limited. Diplomatic channels reopen fast. Oman, which was already mediating nuclear talks as recently as February 26th, steps back in. The strait stays open. Oil spikes $10 to $15 a barrel and cools within a couple of weeks. Gold tests resistance and then starts leveling off. Silver moves higher at the open, but the fear premium begins to fade. This is currently the most likely outcome according to Lombard Odier. Path 2 is prolonged tension. This is the risk the smart money is actually watching. Iran does not fully close Hormuz, but starts harassment. Fast boats, naval mines, GPS interference on commercial shipping, insurance costs for tankers surge. Asian refiners, China, India, Japan, South Korea start scrambling for alternative supply. Oil pressure becomes persistent, not temporary. Inflation expectations start creeping higher again. Gold enters a more sustained uptrend. Central banks, already buying gold at the fastest pace since the late 1960s, likely accelerate purchases. This is the scenario that keeps metals elevated for months, not weeks. Path 3 is full closure, low probability but massive market-changing impact. Iran effectively shuts the strait. The U.S. Navy gets pulled into a sustained effort to reopen it. Oil surges to $100, $120 or higher. The inflation shock could rival the 1973 oil embargo. Gold stops being a hedge and becomes a core institutional allocation. The dollar gets caught between wartime strength and inflation weakness, and historically, that kind of currency tension tends to favor gold hard. 3 paths, 3 very different outcomes. But here is the part that most people still do not understand, and this is what actually changes everything right now. Almost no breaking news coverage right now is talking about this, and it might be the most important factor in this entire situation. I call it the silver floor. The silver market going into this conflict is structurally tighter than at almost any point in modern history. 6 straight years of global supply deficits, a cumulative shortfall of over 820 million ounces according to the Silver Institute. COMEX registered silver is down roughly 75% from its 2020 peak. Industrial demand from solar panels, electric vehicles, and AI infrastructure is still growing, and major silver producer Fresnillo just cut its 2026 output guidance by 9%. In past geopolitical shocks, silver had supply cushion. When the fear faded, silver fell back. That cushion absorbed the drop. But today, that cushion is almost gone. Mine supply takes 7 to 15 years to bring online. Higher prices do not create new supply overnight. That means even if the fear premium cools under Scenario 1, silver has a structural floor underneath it that simply did not exist in previous conflicts. For the first time in a major conflict environment, silver's safe haven demand and its industrial fundamentals are both pointing in the same direction at the same time. That is a setup we have not seen before, and most people watching the headlines right now have absolutely no idea it exists. So what does all of this mean for you practically? Because information without action is just noise. If you already hold gold and silver, the worst thing you can do right now is panic sell into the first spike. That is how regular investors hand their profits to institutional players who are calm, patient, and strategic. If you are watching those prices jump and thinking about selling, ask yourself first, which path are we on? If it is path 1, the spike will cool. If it is path 2 or 3, what you are holding could be just getting started. If you do not hold any precious metals and you are considering buying, understand the risk. Buying into a fear spike means you are buying at elevated prices. If de-escalation happens quickly, you will be sitting on short-term losses. That is not wrong, but you need to know what you are walking into. Dollar cost averaging, meaning buying smaller amounts over a period of time rather than all at once, is almost always smarter in volatile moments like this. And regardless of what happens in the next 72 hours, the 3 things you need to watch closely are oil prices, shipping conditions in the Persian Gulf, and any diplomatic movement through Oman. Those 3 signals will tell you which path this is actually going to take before the headlines catch up. Here is where everything lands. Bombs hit Tehran. Silver jumped nearly 5%. Gold is testing major resistance. But the real driver is not the headlines. It is the Strait of Hormuz. And whether the Hormuz effect creates a 2-week spike or a 6-month trend depends entirely on which of those 3 paths this conflict takes. Scenario 1, rapid de-escalation, is still the most likely. But Scenario 2, prolonged disruption, is the real risk sitting just under the surface. And what makes this moment structurally different from every conflict before, it is the silver floor sitting underneath the entire precious metals market. In past wars, fear spikes faded and silver had nothing to catch it. This time, it might. If you found this breakdown useful, subscribe to Richest 1% Files. We break down how the world's biggest events connect directly to your money, your investments, and your future, without the panic and without the noise. Drop a comment below. Are you holding gold or silver right now? Are you thinking about buying? I want to know where your head is at. See you in the next one.